Hi, everyone. I'm Catherine Anaya. Thank you so much for joining me for the Women's Eye podcast, where we introduce you to fascinating women who are leaving their mark and making a difference and changing lives. This episode is brought to you by CASCO Financial Group in Phoenix, Arizona. Catherine Scrivano is the president of CASCO Financial Group. She founded her business to help people create the financial strength needed for achieving their dreams and building that money power. Her belief is you do not have to be wealthy to be wise. And Catherine is my guest today. It's always great to see you, Catherine.
Great seeing you as well.
Well, thank you. So here we are, already nearing a couple months away from the end of 2020, still in a pandemic. I don't think any of us thought we would be here at this point in time, experiencing this still, but plenty of discussion going on right now about this ongoing impact of the pandemic on the economy, whether it's small business or personal finances. It can be really overwhelming at times, wouldn't you say?
Absolutely. It's getting a lot of attention. And anybody who's following the news or listening to podcast media in general, we're talking about the economic impact of this experience.
And there's no sign of it ending anytime soon. So today you're going to help us understand the financial terms that we often hear, but may not necessarily understand. They're financial terms, you say, that are important for us to know because they could impact our lives. So can you explain that a little bit more about why that is so important?
Well, as I mentioned, I think we are being bombarded with information, but not necessarily knowledge. And so we think a lot of these terms that we hear are really important, but not everyone understands whether or not it applies to them.
Well, I know I'm in that boat, definitely, because, if my financial advisor sends me something, I say, okay, can you please speak in my language? Or if I hear something on the news and I want to send him something, I say, can you please break this down for me? So it really is important to be able to understand these terms and be able to converse with somebody about them.
I know you have a great relationship with your financial advisor. We've talked about this before, and you've told me one of the things that he does is help you understand what is meaningful to you versus just background noise. And I think that that's an important role for a financial advisor to play.
Absolutely. And it's always good to go into those conversations having at least some basic knowledge. So before we get into the conversation, I know that you have a disclosure that you'd like to mention to our listeners and viewers about broker-dealer information.
It really is important. In many of our conversations, it's not been relevant, but because we're going to be talking about investments, it's important that anyone know that I am a registered representative. I work with an independent broker-dealer called Cetera Advisor Network. And certainly none of our conversation ever has been or will be sales oriented, but it's only fair that you know that I am a registered representative.
Thank you very much for that. So let's get into the terms. Let's start with indexes. When we hear about, the Dow index or the S&P 500 index or the NASDAQ index, what is the index? I know we're not talking index cards.
No. You know what an index is? It's an imaginary portfolio. Isn't that funny? This is your imaginary friend or enemy. But they're imaginary portfolios of securities that represent a particular market or a section of a market. And each index has its own method of calculating a change in value. It's usually expressed in percentages. Now, everything in the index has something in common. They might be on the same stock market exchange or be in the same industry, any number of things. But be aware an index is pretend.
Okay, so when we're hearing those numbers, again, we just need to think in terms of it's kind of like a binder, and these are not real numbers?
They are real numbers, but you cannot invest in an index, for instance.
Okay.
There's no such thing as saying, okay, I'm going to buy Dow or the S&P or any of them that we talk about. There is no investment that consists of the index.
Okay.
Not directly. Some investments track an index. An investment may include only holdings that are available within a certain index. but from there, there might be a lot of variation. It's not going to be exactly identical to the index. So
Okay.
there's your opportunity to say, does this information about the index actually pertain to my life?
And it's like we said from the beginning, this is all about understanding terms and how they impact your life, because everybody is different. So when you hear the Dow, okay, so, the Dow is up a percentage point, or the Dow is down percentage points today, or the market is up, or the market is down, or the market's about to crash, or the market's about to take off, so many things.
That's right. Plunge and surge.
Well, it can get so confusing. So
sure.
Let's
start with the Dow.
Yes. What is the Dow?
Do you know that the Dow only tracks 30 stocks? These are
really
30 large publicly owned stocks that are sold on U.S. stock exchanges.
So when we see the tickers and we see certain names, really we're seeing the same names over and over?
If you're watching the Dow, you're watching the same 30 stocks over and over again. So we tend to get pretty excited about what's going on in the Dow, but if we stand back a bit and think about it, that's really only 30 stocks. If you think of all the publicly traded stocks in the whole world, we do have a global economy. We're very affected, or we think we should get excited about the activity in only 30 of them. Maybe not so much.
Well, why is that? Why can that influence somebody's day, good or bad, in such a major way, if it's only 30?
If it influences us, it's because we let it. But the Dow Jones Industrial Average was formed. I wish I knew it. I think it was in the 30s. It was a very long time ago, and kind of became a standard. And other index have been developed since that are much broader, or they may be even more specific to an industry, for instance. Maybe it's precious metals, energy, currency indexes, that track global exchange of money. Maybe it's an index that follows a geographic area. Any number of things can be represented by an index. It's all just statistics. I don't mean to imply that they're not important, but I want to be sure that folks know what they are so they can decide if it's relevant.
Sure. And so when you're hearing market indexes, then how does that become relevant?
Well, again, what is the market? Is it the real estate market, the oil market, the gas market? And then that's when you decide if it's relevant or not. It's also, if you decide that you want to respond to news on a particular index, it's important to think about how the companies within the index are performing. For instance, this year in 2020, the Standard & Poor's 500, we call it the S&P most of the time. Those are 500 most commonly held stocks. Do you know almost all of the gains have only come from 13 of those companies?
Wow.
Out of 500, 13 of them are responsible for most of the gains. There's 34 companies in that index whose value has dropped by half this year.
Now, so is that because of what we're all dealing with this pandemic, or is that just the nature of how it works?
It's just the nature of how it works. It's a very broad index. It represents a lot of different things. If you look at those companies who have performed very well this year, you're going to find the names that you would guess, those that have benefited from the changes that we've gone through this year. Again, this is just statistics. I bet at some point you have listened to or you're aware of the show A Prairie Home Companion. And
I am not.
This was an old, very famous radio show. I say old, it's not that old. It's within the last 10 years that they've been gone. But Garrison Keillor used to always talk about his home in Lake Wobegon. And one of the lines was where all the children were above average, which is a great comedic effect. But to get averages, we have to have underperformers and overperformers.
Right, exactly. And then find the middle.
So we know that the averages, they are interesting, maybe a starting point do they mean anything to me? That requires some deeper exploration.
Right. Okay. So people tend to understand that the market has to do with stocks, but how does it apply to everyday life, especially when we hear, say, for example, the market has crashed?
Well, you just said something that I would like to change a bit. When we talk about the market, I'm interested in what market. Are we talking about the stock market? Are we talking about the bond market, the oil market, the real estate market? I mean, that's a big question. So when I hear someone say the market has crashed, I ask three questions, and I would encourage you to do the same. First is what market? And the second is what is the source of the information? Sometimes to get attention, news outlets or your coworker will use the word crashed, and really what they mean is a slight decline. So I hear that overstated all the time. And then the third question is the one that we're talking about today. I think the most important was, does this have any effect on my financial life?
Very important, especially if we're going to react to it in whatever way we choose to. Before we get into some of that financial language we often hear, let's talk about basic investment terms like stocks and bonds. You've mentioned bonds already. For those who invest already or maybe want to start investing, what do those terms mean, stocks and bonds, and how do they differ?
Stocks mean that you have ownership in a company. Bonds represent money that has been loaned to a company or perhaps a government entity. And there are so many variations on those two, but if you understand that stock is ownership and bonds are loanership, I don't know if I'm allowed to make up words as I go, but you know, we can take those two concepts and break them down, you know, almost exponentially. But the difference between the two is whether you own stock or you are loaning a company or entity money. Then you've got you own a bond.
Okay, so when we delve into this financial language, then let's start with volatility. We hear that a lot. What does it mean if the market is experiencing volatility? And as an investor at whatever level, how should we react?
You know, volatility almost always is interpreted as going down, but just by the definition of the word, it also means going up. Gains are volatility as well. It just means the market has gone up or down. As an investor, you can take advantage of volatility by buying when prices are lower, selling when prices are higher. If you are investing in professionally managed accounts like mutual funds, then that's what you've hired the managers to do, is make those purchases and sales strategically and without emotion, just based on the fundamentals.
Which is exactly what mine tells me when I call on a day when I hear that the market has crashed and I want to know, am I poor?
And I'm sure he never says, yes, you're poor.
No, he says, relax.
Relax. We have professionals who are taking advantage of the situation.
Okay, what about returns or performance, which kind of segues into what I was just saying. What does that mean, and why is it important to also understand how that return was achieved? For example, you have this great shoe analogy, which I love, and I think that sums it up greatly.
I love my shoe story as well, but let's start at the very beginning. Is that showing an average return is only part of the story, because that doesn't tell how the return was achieved. For instance, was it a volatile one where throughout the time period you're looking at, it went way up and way down and lots of dramatic variations? Was it slow and steady over time and again? Sometimes returns come from the reinvestment of profits or dividends or interest, buying more shares. So the value didn't change much, but you ended up owning more shares. So let me tell you my shoe story about looking at returns. I can't tell you how often we have worked with new clients and ask them, how did you make the investment decisions that are represented in your portfolio now, especially those who have retirement plans through their employer? And their answer is, I looked at last year's performance and I bought the ones that were doing the best.
Mm-hmm.
I say that's just like going into a shoe store and saying, sell me the most expensive pair of shoes. That's the only thing I'm interested in, is paying the most for it.
And why would we do that?
It's like looking back and saying, this mutual fund was the one who made the most money last year. That's the one I will invest in. But if you're going to hike the Grand Canyon and you end up walking out with the most expensive pair of shoes in the store, but the heels are 4 inches high and the size is too small, this was not an appropriate investment for you. So returns are part of the story, price is part of the story, but it's not the whole story. You do need to dig in a little deeper.
Yes, indeed.
Those high heel, too small shoes are not going to give you any comfort knowing that you paid the most for them.
Although you could dig in pretty well with 4 inches.
But 2 sizes too small. That's the part that gets me.
Exactly. So let's talk about risk, which seems pretty self-explanatory, the potential loss of monetary value. But you say it's important to understand your tolerance and to consider other risks like not reaching your goals or outliving your money.
Huge. Right.
Yes. Can you dive into that a little deeper?
Well, you just think about risk as a little bit more than simply market losses or the potential for market losses. Think about the risk of not reaching your goals, and what would you do if you didn't have sufficient dollars? What if you're not able to keep up with inflation? One of the ways that I'm noticing inflation is impacting us is, do you notice the sizes of the packaged goods that we buy are smaller? If you look at the size of a roll of toilet paper, they're getting smaller. Do not get me started on candy bars. The candy bars that I had as a kid were big enough to share, and that's not so much anymore. So,
well, and open up a bag of potato chips and half of it is air.
I haven't done that one, but I believe it. So, but that's inflation. If the price hasn't gone down, but the quantity that you're buying is smaller, that's another way of looking at inflation. That's a risk. Outliving your money is a risk that a lot of our clients express concern about. Not having saved sufficiently, having a long lifespan, and having to make compromises in dignity. That's a huge risk for a lot of people.
Let's talk about diversification, because that is having a variety of investments. You say that's not guaranteed protection against losses, but it can help us avoid some of those knee-jerk reactions that some people might tend to have to what might be happening in the market that don't apply to your personal situation. Can you give me an example of that?
Well, even if it does apply to your situation, if you hear news and you say, oh, that affects me, rather than a knee-jerk reaction, I would like you to think about what else you own. Hopefully your portfolio was designed as part of a comprehensive plan. For instance, if you were in an elevator and you're on the top floor of a multi-story building and you become aware a cable has broken, if there's only one cable, you are in big trouble. But if there's multiple cables, they're all doing what they're designed to do, it may be disconcerting, but you may have a little less worried and a little less reason to be concerned.
Well, and when you're talking about that, benchmarks then become pretty relevant too, because you have something you have context, right?
Well, that's another one of our buzzwords is benchmarks. People compare their portfolio to a benchmark, or maybe a part of their portfolio to a benchmark. That's perfectly appropriate, but make sure that your comparisons are realistic. If you're holding a bunch of small company stocks and comparing them to an index like the Dow Jones, which is those 30 huge companies, it's apples and oranges. It's not relevant. So I'm asking you to understand the word the definition of the word benchmark and make sure that you are making apples to apples comparisons when you use that information.
Well, and making sure that that applies to you
Exactly.
personally, which is what we're talking about, your own personal situation. So now that we've gone through all of these terms, I think we can all agree that it can be intimidating. So what is your best rule of thumb for diving in, for understanding, it's important to know the definitions of these terms and how it applies to, like we're talking about, your own personal situation, not everybody else's situation?
I would start with having some awareness of the terms that you seem to hear most often, and then pausing to make sure you understand not only the definition, but how and if the term applies to your personal circumstances. With that information alone, you're going to be rewarded with insight, and you'll be able to use the information to your advantage.
Wonderful. You are always so great at putting all of this information into perspective and in a language that we can understand.
I hope so.
Thank
That's
you.
My goal. Thank
Yes. You're wonderful, Catherine. Thank you as always. Also, thank you for being a regular contributor here to the Women's Eye podcast. We certainly appreciate everything that you have to offer, all of the information and wise words. So thanks. You can learn more about Catherine on our website at thewomenseye.com. And do not forget, The Women's Eye has a book. It's called 20 Women Changemakers. You can find it at changemakersbook.com. And that's going to do it for this episode of the Women's Eye podcast. I thank you so much for joining me. I'm Catherine Anaya. Until next time, remember, it's the world as we see it.